BlackRock is an incredible stock. We do get a double buy rating from Seeking Alpha and Wall Street, and in today's episode we are going to find out if it is an undervalued must buy for the portfolio. It is down around 2% year to date. We're going to do our usual analysis. We'll take a look at the dividend safety, more importantly a lot of underlying financial metrics. We'll look at both insiders as well as institutions to see their movements, both buys and sells, and we will take a look at their latest earnings report. A lot of very positive signs for this company over the next few quarters. And as always, we'll do a deeper dive, top line revenue growth as well as bottom line net income. We'll also look at the health of this company, their total cash versus their total debt, and we will run them through the valuation model. We want to get to our intrinsic value, our acceptable buy price given our investor margin of safety, as well as looking at Wall Street, seeing their own price target for the next 12 months. In terms of their historical performance, well, yes, they are down around 2% year to date. Over the last year, however, they are up around 24%. Over the last 10 years, if you are a shareholder, you would be up 168%. Bear in mind, doesn't include dividends reinvested, so you would be up slightly higher. And all-time high sit at just under $1,000 a few years ago. Now, we did mention a double buy sign, as we can see, including Wall Street. We can also note it is towards the upper end of the 52-week range, with a forward yield 2.58% and a forward P around 19. That is sitting below the S&P 500, which is around 21.5 to 22 in today's current value. So let's take a deep dive at the numbers. Firstly, though, when we do take a look at their latest earnings, Q1 2024, as we can see, April the 12th, so they did just report this a few weeks ago. One of the things we do want to highlight, a record 10.5 trillion in AUM, so assets under management, which is up significantly 1.4 trillion year over year. This is a very important metric for these asset managers like BlackRock. In terms of their revenue, we've seen an 11% increase to their top line year over year. Now, we will look at this in a bit more detail over the last 10 years. And we also notice some very strong increases, 18% to their operating income year on year, 37% in that diluted earnings per share as well. And one thing that we will cover is the essential amount of share repurchase they do, as well as returning excess cash also through those quarterly dividends. So in terms of their top line revenue growth, typically 3 to 7% as a minimum increase on the baseline level. 11.1 billion reported in December 2014. We have 17.9 billion in their latest annual report, so nearly doubled their top line. We can take a look on a more graphical basis. Don't expect massive growth year on year to their top line. Overall, though, it is moving in the right direction, and we'll shortly look at the percentage format as well for this growth. In terms of the bottom line growth, we see a very similar trend. 3.3 billion in December 2014, 5.5 billion in that latest annual report. Very similar to that top line. We do see on a graphical basis, it is moving in the right direction, but again, not a very rapid rate. This is, however, an asset management company, so don't be expecting massive fast growth like you would in perhaps the technological sector. So moving on to the health of the company, total cash and short-term investments versus total debt. 6.2 billion onto the balance sheet in 2014, 9.1 in their latest quarterly report from April the 12th, as we just saw. In terms of the overall position on the longer term, it has increased, but again, a little bit inconsistent year on year, and this isn't a number that has any value unless we compare it. So we will have a look now at that 9 billion versus their total debt, and we'll see that movement numerically and directionally. 4.9 billion in December 2014, and we can see it has grown, in fact, more than doubled, 11.6 billion. When we take a look at it, similar to the cash, a little bit inconsistent. Nonetheless, it is increasing year on year. Maybe not the greatest sign that you do want to see in the majority of companies, but there isn't any red flag indicators here. There isn't rapid growth of their total debt, and it isn't too far off their cash position either, which is something we will look at when we analyze their dividend safety. Now, a few things that we do look at in terms of their earnings, how they've performed, future earnings expectations. First thing to note, the last 4 quarters, including the more recent one, Q1 of 2024, They have beaten earnings per share quite some distance as well. If we go to Q3 by $2.57, the last two as well, 78 cents, 42 cents. So their track record is 100% over the last year, so very positive to note. Second thing we do want to point out, the next quarter EPS, there is anticipated to be high single digit increase year on year. The next one, we do anticipate a negative growth. Q4 of 24, 14.33% year on year increase. Q1's high single digit 7.3. So overall looking very positive, past record looking very strong, forward looking also looking fairly healthy. So when we take a look at some of the grades, the first one, the valuation grade, a D-, as we can see many different ways to value. One that we do look at is the P on a non-GAAP basis, forward looking 19.1. We do note the sector median around 10.69, so they are trading at a premium of around 79% against the sector on average. But again, you could argue that this really, you have to dig deeper to understand other companies in the sector to see whether or not they are of the same quality, but something we just want to draw your attention to. Other valuation methods here as well, if you do want to include that in your own investment thesis. We then move on to the growth grade. They get a B-, few things to look at. Top line revenue growth year on year, 5.3%, marginally higher than the sector of 4%. Forward looking, high single digit, 8.02 versus the sector around 5.12, so looking very healthy. And when we do take a look at the earnings per share over the next 3 to 5 years, it is anticipated by the market to expect 13.32% year-on-year increases, with others around 9.6. So you can understand if this is expecting higher growth in terms of the earnings per share, then you would anticipate in terms of the sector to be traded at a price also higher. But again, do what you want with this information, add it into your investment thesis alongside the other metrics that you can see here, or if you want to exclude, at least the information is there. In terms of the profitability grade, well, they get an A. Few things that we want to point out. Gross profit margin, 49%, significantly under the sector, in fact, of 59.5%. Net income margin 32.26, higher than the sector median of 23.24. And when we do take a look at cash from operations, significantly higher, 4.15 billion versus the sector median of 165.31. So if we are to wrap up these gradings, well, firstly, a double buy signal, 1 hold. We get a valuation score of a D-, growth of B-, profitability of A. So overall mixed, but again, this will depend on different investors and their strategies as to how they do analyze these companies. We're then looking at the performance over the last 10 years against others in the asset management and custodial banks sector. We have KK&R & Co., Blackstone, Brookfield Corporation, Ares Management, and the Bank of New York Mellon Corporation. Now, we do know over the last year, this includes dividends reinvested. Total return, they're up 27.1%. In fact, surprisingly, they are the worst performing, yet they are up fairly strong. When we expand this over the last 5 years, we do know in the middle performing up 105%. Again, not the greatest when you do compare it to others in the industry, but overall still fairly healthy for a 5-year time frame. When we expand it over the last 10 years, again, pretty much the same sentiments there. Very healthy, 245.4% increase. But when we do compare it to others, they have performed a lot stronger, like KKR, like BX as well. But when we do go for the maximum period, and we can see that this does start from around 2000, 8,980%, the best performing from inception. As always, though, it is important to understand that past performance is not an indicator of future performance, just something that we do like to show on this channel. Just to let you know, we have released our latest free weekly article. If you want to gain access to this or any other articles, all completely free, instant access, do click on that pinned comment below. Just to let you know, this article here, we do run through all the websites and resources that we use on this channel to essentially analyze stock. Now let's jump into insider movement. Now we do notice 8 instances of insider sales over the last 12 months, 0 insider buying and 0.9% insider ownership, with a total of around 98 million of insider sales. We notice we have to go to around Q1 of 2024 to see the first insider selling of around $72 million. When we take a look at who these are, well, in fact, the CEO, Lawrence Fink, did sell over 30,000 shares 28th of February for around $809. We can see here this is around $25 million. We also notice other instances of insider selling as well. Information is there. There was no insider buying, so nothing we can comment on that. But preferably in terms of using it in our own analysis, Insider buying is a lot more useful as a signal, as management buy if they believe the share price will go up. In terms of insider selling, we really don't know why. It could be personal, it could also be financial. Now, in terms of institutional ownership, just under 81%, 34 billion worth of sales by the institutions over the last 12 months. In fact, more than double buying over the same period, 77 billion. And on top of that, we see more buying in the more recent period as well. Q1 2024, 1.2 billion versus 519 million worth of sales. So not just over the last 12 months, but also the more recent period. But please, as always, do your own due diligence and never copy what any of these institutions or any of these insiders do. In terms of dividend safety score, 98, very safe. Market cap, 117 billion, a mega cap company. And we can see that it was reaffirmed just a couple of months ago that a dividend cut is highly unlikely for BlackRock. Now, last essentially recession, how did they perform? Well, they maintained the dividend during the 07-09 crash. They had negative 22.5% recession sales. Bear in mind the S&P was around negative 12, and they also marginally beat the S&P, negative 50 versus negative 55. In terms of dividend growth, well, very poor this January. We always like to see and advocate on this channel a minimum of 4% just to keep up in line with inflation. However, over the last 5 years and the last 20 years, we do see some strong double-digit growth. One of the reasons why we were disappointed this year. And we do know they have been increasing those dividends for 14 years whilst paying a dividend without a reduction for the last. In yield theory, company is undervalued when the current yield sits above the 5-year average. So we have a sign here of reasonable valuation, 2.55 versus 2.67. Forward P pretty much in line with the 5-year rolling average, and we do note, as we mentioned earlier, significantly higher than the sector P, which does sit for financials at 11.5. As always, draw your attention to free cash flow, not the earnings, which is susceptible to manipulation by management through accounting, and this does help us spot any dividend cuts that are looking to be on their way. Below 50% if we want to be industry specific for asset managers. Now, what we do note here is it has been pretty much higher than that every single year over the last 10 years. Positive to take away here, 2024 expected to be down to 46%, and that is why we can see a very mediocre increase in 2024 due to the fact the payout ratio was very high. Hopefully, January next year, we do see a much stronger increase like we have seen and typical from this company. Free cash flow per share always increasing is the target that we want to see over the longer term. A little bit of inconsistency, but we do note it has increased from 2014 to 2023. Expectation is a massive increase into 2024, something just to bear in mind as we do use this as part of our valuation model later on. Sales growth, as we said, 3 to 7%. So we do see the percentage format. Last 2 years been fairly poor, especially when you look at the last 2 years before that, and strong double-digit growth expected, or in fact, the trailing 12 months does show 5%. So hopefully we can see very nice increases to their top line. And as we did look at their earnings, just quarter on quarter as well as year on year, we did see around 11% growth. Total sales numerically, well, we covered this already, just another format to see. Shares outstanding, this is important to shareholders because it does show us when companies return excess cash to share buybacks, essentially giving you a larger portion of the company. Now, we do know that BlackRock do this consistently. Not a massive amount, but nice to know at least they are doing a little bit year on year, always better than nothing. In terms of ROIC, return on invested capital, personally I want to see a minimum of 10% just to give us faith management are able to effectively allocate their capital. Asset managers, you can bring it a lot higher to 25%. For me personally, as it is above 10% and it is very consistent, this is something that I can be satisfied with, but as always, different investors will have different metrics as well as different targets. Operating margins, well, above the 25%, we do note it is very inconsistent, some years looking very strong and increasing from the previous years, other years it isn't, but at least it is very consistent. In terms of the free cash flow margin, we also note it is above that minimum 20% year on year, so there's a positive sign. It does make it fairly attractive for those potential investors who are considering investing in this company. Net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, below 1.5 for asset managers. Remember, these numbers, for those that are new, signal the number of years it would take the company to pay off all of that debt net of cash on hand, and also correlates to both balance sheet strength as well as dividend safety. What we note here, 0.15 in 2023, 0.28 expected in 2024, and has been euro for a significant number of years, showing us that their balance sheet is very, very strong and that dividend does look to be very, very safe. So let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, the first model that we're looking at is the multiples valuation model. Companies in a similar sector and size, their P multiple, the average multiplied by the EPS of BlackRock to get an intrinsic value. Now we have our first signal here. It is overvaluation as the market value is above the intrinsic value. Just bear in mind we're not looking at any one of these models in isolation, and we will conclude shortly. The next one is the dividend discount model. We have the yearly dividends. Growth has been very nice, just under 10%, although we do note a little bit of a disappointment, as we mentioned earlier, given the historical increases we have seen. Forward looking, we've gone 6%, so lower significantly than the average to be a little bit more conservative. This does show an undervaluation signal with an intrinsic value significantly higher than the market value. We then move on to the DCF model, where we have the free cash flow year on year average at around 7%. Now we have gone for 12%. The expectation is that next year it will be very, very high, nearly 100%. So this is forward looking, so we have gone for 12. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we can see here an undervaluation signal. So in the intrinsic value, it is essentially the average of these three models. Don't forget, you can click on the pinned comment below where you can pick up a copy of this stock valuation model to get to both the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list. So intrinsic value for BlackRock in today's episode is arriving at $887. Margin of safety, remember we don't execute yet until it has at least a 10% margin of safety, and that is if it meets the 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that for BlackRock, well, it currently has a 10% MOS level, but again, different investors, different risk levels, and different MOS levels that they target. For those looking at 15%, a buy up to 754. Those at 20% around 709, and at 25% around 665. But as we mentioned in today's episode, the margin of safety does sit around 10%. In terms of Wall Street and their price expectations over the next 12 months, well, as we saw at the beginning, they do believe this is a buy now for the portfolio. Price forecast $980, upside signal around 23%. Definitely one to consider based on the information we have run through. But as always, let us know your thoughts in the comments below. Is BlackRock one you are considering for your portfolio? Maybe it's one you hold, or maybe you are waiting for it to come down lower. And as always, if you do enjoy the content, smash that like button, hit that subscribe and bell button, let us know your thoughts below. And as always, we'll see you all on the next one.